All right, well, hello and welcome to the second of a three-part Financial Capability Month webinar series. I'm Tara Ford Payne, Vice President of Communications and Outreach at the Federal Reserve Bank of Dallas. And as you know, April is nationally recognized as Financial Capability Month to highlight the importance of financial education and to inform all of our citizens on how to maintain healthy financial habits. During the webinar series this week, we're covering topics on the state of financial literacy, historic and cultural trends in banking, and building wealth. Yesterday, we covered the state of financial literacy with a presentation on retirement trends and how vulnerable populations are faring. We had an insightful panel discussion with leaders in the industry who are executing on financial education programs across the state to increase consumer financial well-being. So just a quick word about the difference between financial capability, literacy, and education. Financial capability goes well beyond financial literacy or financial education. And while it's important to possess foundational basic financial knowledge to plan for our goals, to save, to invest, build credit, and protect our wealth, it's equally important we all have access to safe and affordable financial products from our banks and our credit unions. I'm reminded of the words of one of my colleagues during yesterday's session. We have an economic imperative. It's not an option to bring all people into the mainstream. At the Dallas Fed and throughout the Federal Reserve System, we're committed to building a stronger economy that creates opportunity for the people in our district. We embrace diversity, we promote equity, and advance inclusion in the work that we do. The Fed supports minority and women-owned banks with its Partnership for Progress program that started in 2008. And that program implements efforts to preserve and promote MDIs, providing them with the technical assistance, the training, the education, and convenings. We invite you to visit partnership.gov for more information on that program. Today's webinar will take a closer look, a historical overview of the banking system with the focus on the first African-American banks. And it may provide some context into entrenched barriers we see in today's banking system. Before I introduce our speaker, I have some prerequisites, housekeeping items. We ask that you stay on mute. We will take your questions at the end of both presentations. And if you have a question, please either use the raise your hand function and we'll call on you, or feel free to drop your questions in the chat box. Our first speaker, Tim Todd, is an executive writer and historian with the Federal Reserve Bank of Kansas City. He's the author of 7 books on the history of banking and financial services, including most recently, Let Us Put Our Money Together, the founding of America's first Black banks. He also served as a writer and associate producer for a documentary about the history of the Federal Reserve that was produced by the Kansas City PBS station, KCPT. Prior to joining the Federal Reserve, Tim was a journalist for 10 years and spent another 5 as a writer focused on fixed income markets. Following our speaker presentation, Tamara Reddick-Cottrell will lead our Q&A discussion and wrap up our session for today. Tamara is currently an education outreach advisor at the Dallas Fed. Tamara helps build and strengthen strategic community partnerships while delivering effective instructional material that improves access to economic education, particularly in our underserved communities. Prior to this role, Tamara served as a middle school principal, as well as a senior program administrator of Where the Teachers Are, Inc., a nonprofit organization she helped to found. So with that, I am handing the floor over to you, Tim. Thank you.
All right. Hey, thanks, Tara. I'm really happy to be able to join everyone today for this discussion. So let's get things started here. We'll see if I can, if the technology will work and I can share my screen for our slide presentation. So I think you should have that on screen right now. So we'll talk today about the history of, focus primarily on African-American banks in the United States and their history. This is a history that's not been widely known. We wrote a book about this a couple years ago to explore this history. One of the things that we found in some of the other work we had done looking at the history of the financial system is from time to time we would come across stories or items about the earliest African-American banks, but that hadn't really ever been brought together to tell that story in one book or one publication. And so we worked to do that. So we'll talk a little bit about that today. And then we'll talk about what has happened in the years since the first banks were formed. And then I'll conclude with a little bit on sort of some thoughts I have based on my research, sort of looking forward and the environment today. So we'll start with the first thing is a quote from Maggie Walker. And Maggie Walker, you may be familiar with her name. She was an African-American woman. She was the first female bank president of any race in the United States. She created St. Luke's Penny Savings Bank in Richmond, Virginia, as a part of her organization, St. Luke's organization there. And you can read her quote there about the need of putting money together and being able to lend that money back out into the community. And that's really very much the definition of a lot of MDIs, or what we call minority depository institutions in the United States, is taking the assets of that community or its combined savings and then lending it out to foster economic opportunity within those communities. I won't be talking about Maggie specifically today. She comes along a little later in the story around the turn of the century. But I will tell you, if you are interested in learning more about her, there's a book out by a woman named Shanette Garrett Scott. She's actually at Ole Miss, and she published a book called Banking on Freedom that talks about Maggie Lena Walker and also other minority women in the early financial system. So I'm actually working with Professor Garrett Scott on my current project, but that book is really good, and you should definitely check it out if you want to learn more about this period of history or Maggie Walker. So I mentioned that we refer to African-American banks as being within a category of minority depository institutions. So what do we mean? I know we've got people from different backgrounds on today's event. So what do we mean when we talk about a minority depository institution? So that simply means that it's an institution. In most cases, it has 51% minority ownership belonging to a particular minority group. Now, there are other ways that you could be considered an MDI. You could have a more diverse ownership structure, but you could be engaged primarily in serving a minority community. But most of these have at least 51% minority ownership, if not entirely minority ownership. And so the way the FDIC breaks those down, you can see there's a number of Asian or Pacific Islander banks, a smaller number of Hispanic banks, 20 African-American banks, 17 Native American, and then 1 multiracial. In Texas, I thought you might be interested. The landscape is a little different. There are 13 Hispanic American banks in Texas. That's the most of any state. That's more than a third of all Hispanic American banks in the United States. There are 8 Asian or Pacific Islander banks, and then 1 African American bank, Unity Bank in Houston, which I'll talk a little bit about here in a few minutes later in my remarks. So as I talked about with the Maggie Walker quote, when we talk about MDIs, most of them are community banks, and again, doing that basic business of taking a community's combined financial resources and then lending those resources back as a source of economic growth, be it home ownership, buying a home, getting a mortgage, getting additional education, buying a car. Community banks are particularly important as small business lenders, so entrepreneurs often have better success with smaller community banks. These banks also, importantly, particularly in the minority community, are an important source of community leadership. And so a lot of the work that I'm doing right now is focused on Black banks as community leaders through history in the fight for civil rights. And so it's a very important role, obviously. The economic side of the equation is very important as we think of overall equality, civil rights, the access to money and borrowing and better your financial condition is very much at the heart of that.
What's that is?
So the first MDIs, is, I mentioned the different groups, the first MDIs, the African-American banks have a far longer history in the United States, the first of those being Capital Savings Bank in Washington, D.C., which was created in 1888. You can see that the history is not as deep in the other categories of MDIs, but the catalysts behind their creation are the same, in that these were groups and individuals and communities who had been unable to access credit. They couldn't borrow money to improve their own standard of living. So if you look at in our Federal Reserve District, we have part of New Mexico. And so we talk about New Mexico quite a bit, and that's where the first Hispanic American bank was created in 1969 after its founder had been unable to borrow money from the local bank to actually buy some furniture. Not a lot of money. I think it was like a $50 loan just to try and buy maybe a new office chair. And he had been rejected from other sources of credit. And so that led him in the years that followed to create a bank. And so that's definitely a common theme throughout the formation of many MDIs across history. Now, if we look at the MDI landscape over the past 20 years, there's some things here that will stand out. One is that, as you noted, I noted earlier, you had that large number of Asian or Pacific Islander banks, and you can see that at the top of the chart. You can see a little bit of the curve ahead of and after the financial crisis, as you had an increasing number of banks and then a decline after that, which is what we would expect in that type of environment. One reason we have so many, there's actually a couple of reasons we have so many banks that fall into that designation. One is that the FDIC's categories for these designations are a little bit clunky. So Asian or Pacific Islander is a massive geography, right? So you're pulling individuals basically everywhere from Europe all the way through East Asia, the Pacific Islands. So that's a large geography that's lumped in there together. In addition, you have had a significant amount of Asian individuals, wealthy individuals, immigrate into the United States. And some have used their wealth to acquire banks, have become involved in banking. That wealth has also fostered an additional demand for banking services. So that has contributed to it as well. So there's been a lot of research that sort of looks at the MDI category overall, but I think this chart makes pretty clear that you can't really lump all MDIs together. So you have that large number in the Asian Pacific Islander category, and then you can see the Hispanic American and the Native American both had those sort of run-ups to different degrees ahead of and a little fall off after the financial crisis. But obviously the thing that stands out here is the continuing decline that we've seen in African American banks in the United States. So now there's about 20 banks, I believe 19 or 20 right now. It's less than half of what we had back in 2000. So that's a troubling decline. And then making it more troubling is when you look at unbanked or underbanked households. And so what we mean by this is these are households which, if they are unbanked, then they have no traditional relationship with a traditional bank as far as a checking account, borrowing money, savings account, things like that. An underbanked household is one that gets some financial services from a traditional bank, but not all. So a common example of this would be a household that has a checking account but doesn't have a savings account or is not borrowing money from a bank. And so when you look at unbanked and underbanked households, you can see the African American households, that number is significantly higher than the other designations that are used within the data and significantly higher than the overall rate. And so that's troubling, and it becomes even more troubling when you begin to research into the area of alternative financial services providers. So these are the entities like payday lenders, check cashing services, rent-to-own places, pawn shops, places like that. We know that these businesses charge exploitive rates of interest for access to services. And we also know that they are disproportionately located in minority neighborhoods. And there's even been some research on this that's found that these businesses even locate in minority neighborhoods sort of regardless of income level. So if you have a higher income minority community, you're still more likely to find an alternative financial services provider somewhere nearby. Where this becomes even more concerning is that as we have seen the reduction in the number of African American banks in the United States, we know that when an MDI closes, another bank is unlikely to move into that geography to serve that local community. And that means that those areas are going to be vulnerable to these alternative financial services providers. And we know that often minority banks are located in low to moderate income communities. So that means that low to moderate income individuals and families are turning to exploitive borrowers because that's what's available in their community. And we'll talk a little bit more about the issue of proximity at the conclusion of my remarks. And so sort of recognizing all these issues and recognizing that this history had never really been published, my bosses at the Federal Reserve felt it was important for us to explore the history of African-American banks, recognizing that there's a belief that my bosses certainly had that we can learn a lot from the lessons and experiences of the past. And so these were the first 3 African-American banks established in the United States. And what's interesting is that there had actually been efforts in the North about discussions about possibly starting a bank many years before the Civil War. It was seen as creating opportunity for individuals and families living in the local community, and it's also hoped by the abolitionists that would be a very strong symbolic gesture of equality. Obviously, a lot of the individuals involved in that effort were also involved elsewhere. Many were key figures in the Underground Railroad, for example. And so the idea of a bank took a bit of a backseat to the other issues that they were hoping to address at that time. And so we come to the late 1880s, in the period after the collapse of the Reconstruction era. And we see the formation of these first 3 banks. And so I'll talk a little bit about the factors that led to their creation. So the first bank to seek a charter and to gain a charter, although not the first to open, was the Savings Bank of the Grand Fountain of the United Order of True Reformers. So that's a very long name for a bank. And the reason behind that name is that the True Reformers was a fraternal organization that was used by primarily Black men and Black families. And the way that it worked is it functioned very much as a rudimentary sort of insurance provider. And so individuals would become members of the group and they would pay in an amount of dues. And then when a member suffered financial difficulty related to death in the family or illness and job loss, then that money could be allocated towards that individual to help their family through that difficult period. And so there were a number of local chapters of the True Reformers located in the South. They were called fountains. And then the Grand Fountain was the headquarters organization in Richmond, Virginia. And so what occurred over time is as these groups formed and became increasingly popular, there was a group that attempted to form in a community, and they had some difficulty. They weren't able to place their savings within a bank, and they were concerned because they didn't have anywhere to put that money safely. And so they had gone to a white storekeeper, and he had been willing to allow them to put the money in his store vault. But there were some incidents, some race-related violence in the community, and so the store owner and others in the community began becoming concerned and sort of skeptical of what this local True Reformers found and what its intentions were. And so the organizers of that fountain felt like they needed to disband just more out of their personal safety. And so as they were preparing to disband, they reached out to the Grand Fountain. And the organization's founder, William Washington Brown, actually came and met with the group and said, you shouldn't disband. You shouldn't be pressured in this way. I understand your concerns about not having somewhere to store the money. But Brown had an idea that he'd been sort of mulling for some time about creating a bank. And so he used these funds to basically provide the seed money for the bank. And so basically it creates this bank to hold the money from the fountains, and then beyond that to serve the community, hold individual deposits, loan back into the community, all those things I was talking about earlier. So that's the catalyst behind the creation of that bank. Capital Savings Bank in Washington, D.C. was the first to open. It sought its charter around the same time as the True Reformers. Capital Savings was led by primarily an effort of a couple of gentlemen, Leonard Bailey, who ran a number of barbershops in the Washington, D.C. area. He was also an inventor. He did a lot of work, invented mechanical devices that were used for sorting by the military and the Postal Service, different sort of government organizations like that. And Milton Holland, who was a Civil War hero. Together, they and their counterparts had begun to become concerned in the 1880s, the mid 1880s, about changes in the political winds in Washington, D.C. And there was growing concern that African-American rights were going to be curtailed. And so they believed very strongly that one way to fight back against that was to improve the community's economic strength. And so they organized the creation of the Capital Savings Bank as a form of protection against civil rights, to assure their civil rights in the Washington, D.C. area. And again, it was involved in lending to the community, helping businesses get started, all those types of things. Finally, the Alabama Penny Savings Bank was founded in 1890. This was done by a gentleman named William Pettiford. He was a preacher in Birmingham. One of the things he saw at that time was Birmingham was a growing community that was attracting increasing number of Black workers into the city's industrial work. But he felt like there was a missed opportunity there, that there were individuals making money, but that they didn't have anywhere to save this money. And he recognized that if we had somewhere to save this money, we could leverage this resource to help the overall good of the community. And so he was involved in the creation and led the creation of the Alabama Penny Savings Bank in Birmingham in 1890. And so then it's after this then that you begin to see other banks begin to form in the early 1900s. But these first three banks were really exceptional when compared against their banking peers. And there's primarily three ways that they really stand out. The first is, as we've talked about in their creation, they were founded with a vision, and that vision was not to simply open a business, it was to serve the community. So one way to say this, maybe they were more than a bank, that their goals were not necessarily financial return, it was a focus on community service. These three banks, if we had more time to talk about them, we talk about some of the things that they did that were really innovative. And so some of that would be the way that they structured home lending was very different than what some of the other established banking peers were doing in terms of spreading repayment periods out longer, charging lower rates of interest with the idea of fostering home ownership. They operated beyond normal business hours in some cases because they recognized that's when their customers could access the bank. They had to use partnerships, in some cases with white banks, to help their staff become trained in banking because the staffs were coming up. Even the bank leadership did not have experience in banking, so it was very much a sort of learn on the job environment. So very innovative institutions. And finally, and really notable about these banks is that they were particularly resilient. So they were created at a time when the US was very unstable financially. The banking system was unstable. Typical bank of the size of these institutions might last somewhere between 5 and 7 years. The average lifespan of these three institutions is more than 20 years. And so that really speaks to these banks being stability and sort of focused on the basic business of banking during a very difficult environment. And I think that really speaks a lot to the strong leadership of these institutions. And so from after the period after these banks are created, you begin to see an increasing number of African-American banks in the United States. Through the 1920s, you had at least 57 created by 1928. Of course, what comes after that is the Great Depression. And one of the things we see here, and we've seen it time and again in US history, most recently in the 2008 financial crisis, is that the African-American community is hit disproportionately hard during these periods of financial turmoil. And so that led to a lot of bank failures, particularly a lot of Black bank failures. And so there were only 11 still operational in 1960. The number held relatively flat with a few exceptions. And then we move into the beginning of the civil rights era, and then you begin to see a rebirth and interest in creating these institutions and a sort of recognition on the part of individuals and the groups that found these banks, similar to the ideology of those earliest founders, the recognition that banks are important, combining resources, lending back into the community. And so you see about 40 established between the early 1960s and mid 1970s. One of those was the bank in Houston that I mentioned earlier. It was founded as Riverside National Bank in 1963. It was the first Black bank in Texas since World War I. You see the quote there from one of the founders: it was like threading a needle in a windstorm. And so what he was referring to is, as was the case with the earliest African-American bankers, this was a group of individuals who did not have banking backgrounds. They turned to a university professor whose experience and understanding of economics and finance they relied on to serve as president to help them get started. There were challenges in gaining deposits. It's important to understand that when we talk about a bank being a catalyst for economic opportunity, it's also in some ways a mirror of its community as well. And so to be able to lend and do those types of functions, it's got to be able to take in significant amounts of deposits. And so this bank struggled in its early years to generate deposits that were necessary to increase its lending. But it's still operational today, had a name change, has undergone a couple ownership changes, name changed in 1985. and it's now known as Unity National Bank of Houston. And then moving forward from that, the civil rights era, again, you see the decline, the 1980s financial crisis, and so you see the declining number of banks. There were 35, you'd grown that number, and there were 35 closed by 1988. And then, of course, over the last 20 years, we've seen the decline in the 2008 financial crisis, which is particularly painful in the African-American community. And so look into the future, and this is based a little bit on the work I'm doing right now, sort of what are the things to think about, or kind of where are we headed? And so one of the questions is, there's been a lot of interest recently in African-American banking, more so than we've seen in quite some time, more so than we've seen probably since the civil rights era. And so can that sort of generate a brighter future for these institutions and in turn the community they serve? So I think the question is, if the support we've seen a number of large corporations in the United States deposit money in African-American banks with the idea of helping those institutions serve their communities. Is that support going to be long-term and sustainable? Are we going to keep the momentum going that we've seen so far? And I think that's very much an open question. Historically, if you look back in the civil rights era, there was a lot of interest. The government tried to do some programs with, I would term, mixed success. And then over time, that interest has faded. And so continuing support is going to be very important. Another issue to think about is as we think about geographic proximity of institutions. So I talked earlier about the alternative financial services providers, and there's been some research out there that shows that individuals, regardless of income, if you live in a neighborhood where there are a significant number of alternative financial services providers, you are more likely to use those firms. So some people have compared this as one example to, you might know in your heart that you need to eat better, you need to have a healthy diet, but all that's open in your local neighborhood are fast food restaurants. And so you're gonna probably go to fast food restaurants more than you would like to because of the access issue. So proximity is a very important issue as you look sort of across income levels. And that's why I think that makes it even more important as you think about the consolidation of African-American banks in neighborhoods. That increases the concern even more. And then finally, there's issues of cultural proximity. And so this is an interesting issue in that a lot of the times when we talk, or when I go to talk to groups about African-American banks, there's sometimes questions about, well, do you, we don't have the segregation that you had in that earlier era that necessitated the creation of African-American banks. Do we still need African-American banks today? And so if you're, for those who are familiar with, if you go out and look at loan data, you look at things like loan rejections or business borrowing, who gets the full amount versus who doesn't. The data on African-American borrowers or potential borrowers is extremely troubling. And so this is where cultural proximity, I think, may be important. There was a study done in financial institutions in India. They have a unique structure there whereby the bank that we're looking at, the managers changed every few years, and they often would come from different cultures. So they would be from one culture, and then they would move into an area, and they might not be as closely related to that culture. And what this study found, and I've noted it there on the slide, is that when there were cases of closer cultural proximity, so when the bank leadership is more like the community it serves, there were better outcomes for everybody. So that meant that loans within that group were more likely to be approved for the full amount. Conversely, there's also indications that the banks were more successful financially, both in serving their communities and then also even in things like repayment by borrowers. So there's very much a connection there. And I think this is something that is really pertinent as we talk about this issue. And so with that, I'll conclude my prepared remarks. I will tell you that the slim volume we wrote about the history of the earliest African-American banks is available. We have it. You can go to the Kansas City Fed's website and you can download a PDF, or you can send us a request and we'll be more than happy to send you a copy. There's no charge for the book, and we're delighted to share. And so with that, I guess I will turn the program over, I think, to Tamara for further discussion.
Yes, thank you so much, Tim. We are now moving into our audience question and answer. So we are going to take questions from the audience. As a reminder, drop your questions in the chat or use the raise your hand feature, and I will call on you to come off mute and to answer your question. So I will go ahead and start as we are getting some questions in the chat box. Mr. Todd, what are your thoughts about some of the online banking initiatives announced in the last few years that are dedicated to minority communities?
So yeah, so we've seen recently a lot of interest on online banking or app-based financial services. One of those hoping to serve the African American communities, the Greenwood Initiative, being led by the rapper Killer Mike. And some counterparts out of Atlanta. So I think it kind of depends on how you look at those institutions. I think they can be an important resource as we think about individuals, in that it can get them out of that alternative financial services provider sort of downward spiral that can happen there. The thing I think maybe where they don't work as well is that I'm a firm believer that you need to be engaged locally in your community to really serve that community. So as we think of things like community, local economic improvement within neighborhoods, I think brick and mortar institutions are still going to be necessary and essential, not just for the lending, but also just for the community leadership and the important role that bankers often play within their communities. So I think there is some potential in online banking, but I'm always going to be a big proponent of being in the community.
Absolutely, thank you. I believe we have a question from Mr. Curtis Davis. Feel free to come off of mute and ask your question.
Sure, thank you. Great research. And given the research that you've done, do you believe that you have data that would support a reparations strategy rooted in providing seed capital for community-based banks and an annual deposit to those banks that would use the data of banks in the community in general that's being looked at, and the disenfranchised communities in that same community? So again, if you started in 1900, looked in Houston, compared the general population banking community and the African American community's banking deposits and assets, and track that to today, and use that differential as a basis for funding, and both in terms of capitalization and annual depository compensation for those banks to be able to lend. Would that be, is the data available to support the development of such a strategy?
Thanks for your question. That's an interesting question, and that's something I've thought about previously. I would say that the data is probably not available. Particularly, there's a lot of, in some communities, there is a better record of savings and bank deposits in the Black community. In other areas, there's not a good record. Some cities did, like in Chicago, when they had the violence in the early 1900s, they did an extensive community study about financial resources within the community, and that's pretty detailed to comparatively, at least. In other communities, that data is just not readily available. And also, you have a different, the banking system was far less regulated than what we think of today. And so institutions, there's a joke, one of the bankers that I've been writing about in Chicago in the early 1900s, his brother actually makes a joke along the lines of, all you need to do to open a bank is put a sign in the window that says bank. And so you don't have really consistent records over time where you'd be able to do that. But that's definitely an interesting question. Definitely an interesting idea.
Great. Thank you, Mr. Davis, for that. We have a couple questions in the chat. So we're going to start with Eric K's question to Mr. Todd. Thank you for the paper, Cultural Proximity and Loan Outcomes. Are you aware of any study that shows how D&I impact bank performance?
So I am not aware of any specific papers or research out there on how diversity and inclusion can affect bank performance. I do know, and mostly that's just because I'm not saying they don't exist. It's just because I'm looking back, 100 years. But I do know that there are papers out there that I've seen recently that talk about things like, groups that are more diverse are better to reach, are able to reach better outcomes. That they have more involved discussions and that can improve performance in whatever type of organization that you're within. So I know there is some very broad research in that area. I don't know if there's anything sort of bank specific.
Great, thank you. We also have another question then from PK Joseph. The question is, stats on non-minority bank branches alongside the graph showing sliding minority banks in the minority neighborhoods. And PK Joseph, definitely feel free to come off mute if you want to further elaborate on that question. But it sounds like this individual is asking for statistics on non-minority bank branches.
Yeah, so are you wanting to know non-minority bank branches in minority neighborhoods? Is that what you're asking for statistics on, or are you asking on total number of? Okay, so I don't know a lot of the statistics on that. So you'd have to go in and do a complete analysis looking at basically every branch location. I think, from my experience in my community here in Kansas City, I would say there is maybe one or two banks that are non-minority banks that are active in that area. Many banks that I'm familiar with are not engaged in those communities overall. As I mentioned earlier, overall, there is research that shows that non-minority banks are unlikely to go into a minority community after a minority owned bank closes. So I think that sort of provides something of an answer there, or at least some insight there. I would also note that as we think about branches, there's a declining number of banks doesn't necessarily mean a declining number of locations, right? Because a bank might have multiple branches. But when we look at minority institutions, particularly African-American institutions, generally these are small community banks, so they are operating probably only out of one or two locations. So that's not going to be a case where you have a lot of consolidation in the same number. So it's definitely a loss of services.
Absolutely, thank you. Clifton Miller asks, has consideration been given or is consideration being given on the part of financial banking regulatory entities for encouraging the formation of financial institutions in underserved redline communities?
So I will say that, I have not, I can't really speak on behalf of the Federal Reserve as an entity. And so certainly I haven't been involved in discussions about creating or coming up with special programs to try and encourage these types of institutions. Now, Tara or Tamara may be able to speak a little bit to things like we do through the Partnership for Progress and some of the other initiatives that the Fed has done. I'm just not a part of that work. So I'm more involved in the historical perspective. Generally I can say at the Kansas City Fed, we've always been strong believers in the important role of community banks and trying to make sure that there are banks locally serving their communities, providing access to credit and helping serve those communities.
Sure, and thanks for mentioning that. Any references to any of our initiatives, we will certainly be in a position to provide as a follow-up for additional information. So if there's anything that's not completely covered at this time, we will certainly be able to provide that information.
And one thing, Tamara, I might just add to address that question. Sure. When you look at sort of government initiatives, so one of the things that came out of the civil rights era was the government created what was called a minority bank deposit program. And it's still around today, but the program was created with the idea that they were going to encourage government agencies and governments at all levels, so local municipalities, counties, what have you, to deposit money with local minority banks, and the idea that that would help create additional lending resources. That program, I think its success has been at best mixed. There were some regulations on it and some requirements about having to hold treasury securities over certain amounts. A lot of the deposits, there were a lot of postal service deposits that were involved, and those account levels would fluctuate a lot. And so that wasn't a good source of loanable funds. So a lot of times, you see something like that where it's sort of like people whose maybe their heart is in the right place, but they designed something that maybe didn't have the impact that maybe they hoped it would.
Absolutely. Thank you. So we have a question from Travel Agent. Can you tell us what we should say when inquiring about CRA and the financial institutions, LMI, or emerging markets? Also, why is it that many employees know they have community development officers and their critical roles?
So,
we can take that in pieces. So I'll read the
Yeah.
first one again, just to make sure that you got that. So this is from Travel Agent. The question is, can you tell us what we should say when inquiring about CRA and the financial institutions, LMI, or emerging markets?
So are you wanting to, is this someone who, do you want to go to your bank and ask about if they are, what their performance is as far as community reinvestment requirements? I am not involved, and we have folks who work in consumer affairs at the Kansas City Fed who are involved in this type of thing, and the bank examiners who are involved. I'm just not involved in that area as far as getting access or sort of the process that's involved in that.
Sure. And again, that's perfectly okay. I believe that they were just, kind of wanting to know about what we should say, if there's something that we should say about CRA as related to some of the history that you just shared, or is there something that may be a story that we could amplify? The second part of their question then is, why is it that many employees know they have community development officers and their critical roles? So not to assume anything for Travel Agents, and definitely feel free to hop off of mute if you want to jump in, but it sounds like this question really is just asking more about the critical role of community development officers and I presume accessibility to their roles within respective organizations.
Well, right. I mean, obviously they're very important. I don't know. I don't know that I can add a lot more than that. They can be very important in a role of helping serve a community and sort of providing that more broad-based opportunity and development.
Absolutely. I'll take a question that we have as well that was sent to me. What do you think can be done to limit the interest rates charged by payday lenders?
Yeah, so that's, is an interesting issue, and it's something that there has been, some states are doing a better job than others, but that's a state issue. And so some states have begun to crack down on this. So I was in Richmond, Virginia a couple of years ago. At that time, Virginia was pretty much the Wild West and very exploitive. You'd hear stories about someone who maybe needed some emergency dental work and went to a payday lender, and $1,000 dental bill turns into tens of thousands of dollars by the time the interest is applied and they repay that. Some states have gotten more sensitive to that. I live in a part of the country, Nebraska is a nearby state, and they actually had an item on the ballot that was approved last November that's going to crack down a little bit more on payday lenders and put interest rate caps on those firms to try and bring that under control. But those firms can be hugely damaging. Now, they would argue that they are charging this rate because they are taking this risk, and it's an analysis. But the continuing proliferation of these firms and in states where they are lightly or essentially unregulated is hugely problematic and can really get families in a deep hole financially that can be very hard to get out of.
Absolutely. Thank you. And as a reminder, definitely if the audience members have questions, feel free to put them in the chat or use your raise your hand feature. I'm going to jump and ask one more question that I received. This has actually been asked on a few of our sessions. This is day 2 of our series. So what are some actionable ways we can help improve clients' viewpoint or relationships with financial institutions?
So so there's a big issue of trust in the minority community, particularly the African American community, of financial institutions. And so how can you improve that? I think it's incumbent on being out in the community, being engaged in the community. But I think, I don't necessarily talk about a specific bank or some of the things that they do, but a lot of these alternative financial services providers, they're more like maybe going into something like a McDonald's, in the sense that here's our fee structure, and we're right up front about that. And so I think there's a sense that when you go into maybe a traditional bank, that there's some kind of hidden fee or hidden costs or hidden way that you're going to be taken advantage of that's maybe not apparent. And so, how do traditional banks get beyond that? Are there things from other models, other business models that can be beneficial? Detroit Bank actually, at one point, tried to create something they called them local money stores. And basically what they were local check cashing services. They did some postal services through them as well, but the idea was that we're going to get people out of this sort of alternative financial services provider area into something where the rates are a little more reasonable. It did a large amount of business, but it was unable to remain sustainable. It kind of ended up in creating that, the bank was unable to sort of cross promote. So it couldn't tell people that, hey, you're actually doing business with a bank. So they couldn't sort of bring people into the fold that way. So they did a lot of business, but the margins were low because they wanted to try and serve the community, and it didn't end up being viable. But I think there may be, maybe there's some alternative sort of outside of the box ideas or things that can be done along those lines to thinking about serving the community and sort of meeting the community where it's at as far as its comfort level with a mainstream financial provider.
Absolutely. And I know in your presentation, you made reference to those as exploitive practices or by alternative financial, choices that that population makes or whatever. So this definitely speaks to how to improve those relationships to avoid those. So thank you. I believe then, let's see. Oh, we have another question that just popped up as related to payday loans. Let's see. Is the issue with payday loans that clients are not educated about the true cost? Can you give us a little more about payday loans?
Yeah, so I think that's part of it. I think it's also proximity, the issue of that it's right there. That you go in and it's going to cost you, this much money to borrow. So it seems like a very sort of transparent relationship. I know just from going out and talking to people, having conversations, that they are frequently relied on to sort of make ends meet, right? That the next paycheck is not on the near horizon, and so we got to get through this little bit, and so this is an easy way to do it. This gets back into things like, credit rejection rates, even, on credit card applications or things like that, where you can get through to help you sort of get through a rough period. It's just proximity, accessibility, and sort of the feeling that when you go in there, there's a cost, but that's a cost you're willing to assume. Even if on the back of your mind, there's probably better ways to do this. I think the idea of going into a bank and that sort of traditional bank environment feels far more complex, maybe, and intimidating versus the little storefront down on the corner.
Sure. Thank you. So I believe we have Mrs. Demetria Reed McNeil with a question.
Yes, can you hear me?
We can.
Yeah. Okay. I have a question. I serve a community in the Houston area that a lot of people have their money in these banks, and they can't get a loan. from the bank. So we're CDE. We've been a CDE since 2013, 16. Is there any book out there or some information that shows how you should be set up as a credit union or CDFI? Excuse me, a CDFI? I mean, it should be something, some kind of formula that we should be able to follow to help move forward. And I think that's the problem that a lot of the smaller groups like me are having, is that there's no platform for us to even go by. Does that make sense?
So you're looking for guidance on creating a CDFI or creating some other type of organization, and you're having difficulty sort of figuring out how to move forward. Is that
correct? Because the funding is there. I know we're not the only group, because I've talked to a bunch of other groups and they're having the same problem. That when the banks issue money through their CRA, they're issuing it to the bigger nonprofits who don't really need the money, and they're not really coming in our community to issue that money. And we wanting to know how we can go in and help our own people get these loans, because it's not there. The money is being given for the community, but the money is not given in the community.
I would sort of, I guess, pass that question to my counterparts from the Dallas Fed to sort of talk about what resources or what type of discussion might be had, or what could be done to sort of address those types of issues. I'm just not familiar enough with the environment in that part of the United States.
Sure, and that absolutely makes sense, Tim, because it sounds like that's more like a local question. And Demetria, definitely, we have received your question, and what I can commit to doing specifically as a part of the economic education team here at the Dallas Fed is reaching back out to you specifically with any resources that we do have within our wheelhouse that can provide you with that additional support for your question that you're looking for. While I don't have access to it right this second, I can certainly commit to following up with you if you're okay with that.
Hi, Tamara. This is Julie Gunner. I'm in the Community Development Department. And if I could just quickly address two of the questions. One is regarding creating a CDFI. I believe the CDFI fund at Treasury will have the information for that, and I can send you the link to put into the notes after the meeting. And regarding contacting your bank about their CRA performance, I would just call the main number for that institution, or check with someone in the branch if you know someone, or even if you don't, and just ask them who is their CRA officer, or maybe it's called their compliance officer. But their CRA performance evaluation is public information, so they can provide that to you, and you can also find it online. But a better approach is just to talk to them at the bank and ask them about their CRA performance in that community and start a dialogue. So that's my suggestion.
Awesome. Thank you, Julie. I'm so glad you were on the call. I did not see you there. So thank you so much. And also, again, Demetria, certainly if there is any additional information we can provide for you in that regard, it'd be our pleasure to connect you. With that in mind, we have a couple more questions as we're wrapping up here. This question is from Rebecca. The question is, there's a lot of discussion about driving consumers away from predatory lending institutions toward better lending options. But most of the time, a decent amount of savings can prevent needing a payday loan. Are there any initiatives that encourage or educate the benefits of savings? If not, any ideas on how to increase savings among the most financially vulnerable?
Yeah, so this gets back, we spend here at the Kansas City Fed, we have folks who spend quite a bit of time doing financial education initiatives and programs at all levels. So that's, from young school children through adults, helping them sort of sort out their financial situation. Some of that's been curtailed in the COVID environment, but it is a significant issue, and the access to being able to save that money and that sort of traditional banking relationship of where do you safely save that money versus keeping cash sort of in your home or keeping your cash on you. There is work that goes on, but I think the progress is slow and not been as there's not been as much success as I think anyone would like to see on this front.
Absolutely. And Rebecca, toward the end here in just a moment, we're going to share some specific resources that we have here as related to that with the Federal Reserve Bank of Dallas. So hang tight, we're going to get you some of those.
And one thing, sort of maybe the next layer on that question of savings. I mean, there is a history in the United States, in some areas more than others, where banks have been willing to take those deposits from the Black community, but have not been viewed as being as willing to lend back into the community. So if you go back, there was quite a bit of discussion of this in Detroit as that city went through some of its rough years, that it was willing to take money from depositors, but not as willing to lend. If you go back further in history, in the early 1900s, that was certainly the case among white banks in Chicago. So there is as we talk about overall distrust of banks and putting savings there, I mean, this doesn't come from nowhere. There's a history there that is known and has been documented. And so it's, this idea of savings and trusting a bank, it goes back generations. And it's even, it's behavior, that is learned from when you grew up. Did your family have a traditional banking relationship? And so sort of building that trust, it takes time. It's a slow process.
Absolutely. Thank you. We have one other question in the chat. This is from Maxwell Martin. Has the Fed done any research on the racial history and race-biased impact on the recent invention of the credit score?
I am not aware of any specific research on that would be something along those lines as far as the role of the credit score. I know that others have talked about and looked at this issue. I just don't happen to know of anything off the top of my head that would be available from the Fed along those lines.
Absolutely, that's fair. Okay, so we will take, we have time for one other question that was shared with me. And this was one that, again, was asked in other sessions earlier. And this is around the demographics of the, or the composition of the Federal Reserve Bank and its employees, and what is, how is that reflective of its community? There are folks who want to better understand that.
So you mean as far as in the diversity of the staff within the Fed, or is
Yes.
that? So that's something, the Fed has taken fairly, at least in my own judgment, a lot of criticism for not being as reflective as its communities as it needs to be. I can speak to what we do at the Kansas City Fed. We really strive. We have people sort of think of us as flyover country here in the central United States, but we have an extremely diverse population in our district that we serve, and we strive to make sure our employees and our boards and our advisory councils all reflect that. So we have, for example, a significant number of Native American banks, and so we work very closely with Native American communities, in addition to African American populations, large Hispanic populations, all sorts of immigrant populations in our part of the country. And so, but this is obviously an area where the Fed has not done well historically. Some of that is also a function of, there's a lot of role of politics involved as far as you think of leaderships and sort of appointments at the Board of Governors in Washington and things like that are beyond the Fed's control. But obviously within the Fed, we need to do better, and we're definitely striving to move that way.
Awesome. Thank you so very much. That was our last question. And so we're going to close, and I'm going to help close here just by sharing that this historical information is especially relevant today as it helps us understand the statistics around unbanked families and populations in our own 11th district. Specifically in parts of the 11th district, and according to the FDIC, between 2015 and 2019, there was an unbanked population of about 8.8% of surveyed households. What's really important about that number, though, and to understand about that statistic is that only about 2.6% of that unbanked population are white, implying that the other 97% or so are persons of color. Additionally, the FDIC reports that some of the prevailing reasons for not having a bank account, as we've come to learn, among those unbanked households was the distrust of banks, and that the population lacked enough money to meet minimum balance requirements, further perpetuating susceptibility to the exploitive financial options that Tim Todd referenced here in his presentation today. So what can we do? We can all help by supporting financial education, research, and advocating for under-resourced populations. Here at the Federal Reserve Bank of Dallas, we have resources that include our Building Wealth publication, which is a tool that can be used to learn more about budgeting and saving. We mentioned saving earlier, and leveraging access to banks. It supports our financial education efforts. We have our bank's research team, who regularly provide data analysis and reports that contribute to better understanding the economic issue areas within our district. And we have our economic education programming that intentionally seeks to address the needs of our majority minority communities within the 11th district, including our upcoming Women in Economics program series. So as a community member and leader, you can do the same by continuing to learn about the historical references of banking, including accessing resources like Tim Todd's book that we'll share and his presentation today. By partnering with banking institutions, specifically MDIs, as we learned today, by committing to diversity in banking leadership, and by prioritizing financial capability education within your respective organizations and community. Thank you for everyone who came and participated in our discussion today. I would like to share a special thank you to Tim Todd and the Kansas City Fed for lending us your insights today. Be on the lookout for a post-meeting survey we'll send later this week, and we are definitely encouraging you to complete it. Also, if you're looking for access to any of the resources that we mentioned today, definitely visit our Dallas Fed website. We are putting some of those in the chat, and any follow-up communication, you'll be receiving those as well. Lastly, we are excited about tomorrow. We hope to see you for our final session in our series, Building Wealth. Rather than 10 a.m. though, we'll be starting in the afternoon at 4 p.m. Central Time. And it will be tomorrow, and we'll be talking about exactly that savings and building wealth that we were referencing here earlier. So with that, again, thank you all so very much, and we are adjourned.